Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATs, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to discuss covering your losses and taking gains in a volatile market. We'll also look at how to identify when these events are coming and when they might be over. Matt, it's been a pretty crazy last few days in the market. Do you want to share your screen and get us started?
Yes, absolutely. Usually I have the positions, but let's see if I can recreate them here. So Microsoft, this is our earnings trade. So we were short basically the strangle 400, 460. And then if we just look quickly at, actually, let's start with Microsoft. So MSFT, this is the trade builder. So looks like it closed, between those. So those went out worthless. And so now with the market down, so we paid $2.50 for it. So the 385s, 96. So we could go in here. We could look at it for, we could look at a couple ways, but the 385s, 96. Let's see if we could find that expiration. There it is. 365s. So yeah, they're worth $5.78 now. So yeah, that's a pretty big winner for 385s, actually. What am I thinking?
Yeah, that was a pretty good trade.
Yeah, we're up 10 on that. $10 on that. And then the Qualcomm was a 160. Did it finish above 160 on August 2nd? Let's check that out. August 2nd, yeah, it finished above 160. So those went out worthless. So we were just left with the long put, the 155s in 96 as well. So let's check those out.
Yeah, the double calendar in this market has really paid off for us. I know it's one of your favorite strategies, Matt. It looks like it's to be pretty good in this market.
Yeah. Yeah, so there's another $7. So that's $17 less what we paid. So it's probably like $15. But we did have a loser. We had that old SPY Condor that were down $6. So I'd say we're still up a little bit. Our record's still pretty good, Tyler.
Yeah.
All right. Yeah, let's talk about this market. So I think to get some context, if you go to the backtester and you go to the legacy backtester, this is a longer term chart that you could see. So, I like to get some context by going to the longer term chart. So going to SPY, and I have implied volatility at 30 days, the slope, and then also contango. I think I'll take off contango. Well, we'll talk about that in a bit. So if you could go to max, so or you could choose 5 years or 2 years or whatever. So as you can tell, volatility is up, the slope is way up, and we talked about slope, right, Tyler, on an earlier show. We were quoted in risk.net magazine that the slope or the skew, or the puts compared to the calls, have been in a new paradigm, which is to say that I think, and I made the case that since zero DTE started trading, the slope has really gone down because it allowed market makers to really manage their books a lot better. But is this going to be an argument against it? I'll show you what I think right now, but it is pretty high. So it's at 9, which is like crazy. So that's 9%. So you can think about it, every 10 deltas, that slope is 9% more. So it's a 50 vol, the one 10 deltas deeper or a lower strike will be 9%, or half of 9% would be 4.5. So it'd be 54.5. Or it's 100 vol stock, it's 109%. Is that's the difference between the lower strike 10 deltas only and the high strike. Does that make sense for slope, Tyler?
Yeah, and it's a little bit of a tough indicator to understand, but I mean, there's a lot of graphs you can show it too. Maybe if you go to the outlook, you can kind of see the volatility skew and maybe visualize it there a little bit better. Same with the options chain. You can, we have that graph.
Right.
Of,
Yeah. Two very good points. So let's do that. Because that's a huge shift that we're seeing right now is that skew. So here's the outlook. This is stock price graphed against IB. So what we've kind of said in this is when IB breaks, that's when it starts getting a little bit ugly for a stock, and that's what we've seen. Same thing with. This is a really good indicator as well. When the SPY versus its components gets high, that means like if everything's going towards parity, that means there's no benefit from diversification. That's kind of a financial dogma. Diversification is very good. That's what the ETFs are for, basically. But now, when the markets are in peril, the correlations go towards 1. So that's a bad thing that we're seeing there. Contango again is the front months versus the back months. That is contango is positively correlated with the market. You could kind of see it going up and down with the market. And as soon as we lost contango at the high, that was forward looking. So these are kind of signals, Tyler, of that we should be watching to help inform our trading. So I don't really look at slope. It really hasn't tested that well as an indicator in this regard, but this sure looks interesting. The slope versus the components, that looks very correlated with the stock. So maybe we look at that in our maybe that's a good show, Tyler, is to look at slope and that correlation. We could look into it for other stocks too. But so what we're saying is this is a typical July or August 30th expiration. We could go wherever. We just go 30 days out, but you can see that the puts are really jacked, really high, especially compared to the calls. And this is what we've been seeing in this particular graph. This is that jump right there. And what I like to, while we're talking about it, let's go farther back. So here's May 22nd. So I'm going to draw on this. Oops. Let's do that again. I need to start my tool. So let's take a look at skew here. So what my contention is that since this period, which is May of 2022, slope has been in a new paradigm. So what I think is it looks to me like this is kind of the way, maybe a little bit lower. Maybe it was, kind of to here, but you could tell a kind of different paradigm has been entered, and now we just kind of broke out of that. We broke out a little bit here, and we broke out a little bit, of course, right here. So this is slope. So this is something definitely to take keep your eye on. My contention is that with the heavily trading zero DTEs, that market makers are able to hedge out their typical or traditional positions that they have on that are, banks and hedge funds and people buying puts to protect, long only situations. And they're also selling calls to the market makers. So that creates a lower IB in the calls out of the money high strikes and a higher IB in the puts. But since 0 DTE has come and it's been more of an even trade, i.e. more people are kind of buying all types of strikes and there's usually offset, that it has led to take the pressure off of the market makers. But, this is a big move today, Tyler. With them spiking it up, it might say that, hey, under market duress, we're seeing that the market makers are getting in trouble by a lot of people now are buying puts for them, panic buying puts. You see what I'm saying there?
Yeah. So how can we use slope to identify when this situation that we're in the market is going to come to a halt? Is slope an indicator for that? Do we know if slope starts, if that turns around, do you think the market's going to turn around, or how do you see that?
Yeah, I see slope as actually that's really an indicator that's slow. It takes a while for people to get panicked, and it's kind of an indicator that's a trailing indicator. Whereas, I think what we saw here is when slope versus the components, when that fell off, that was a leading indicator. So that started to drag the market down. Contango is a leading indicator. When that went, it started to drag the market down. And to some extent, when IV versus components, this is why we have this outlook page, Tyler, is, we're trying to see what are leading indicators. So those are the ones that I think are leading indicators.
Got it. So, when the IV starts creeping up above that moving average, you're worried about the market going down.
Yep, exactly. I think there's something else to point out. So here's contango. I mean, that's usually bad for the market, right? But it's not in a panic situation. So one of the things that and even implied volatility way up here, it isn't even that high really. So this is what's happening right now isn't even a bad, it doesn't compare to some of the bad things that have happened historically. It's this is 2008 back here. This is 2011 here. There's some pretty precarious situations. 2018. We're not even in 2018. So I think this market, and has a ways to go on the panic meter, Tyler, before it's going to really return.
That's interesting. I feel like a lot of people are already panicking, and you're saying it has a ways to go.
Yeah, well, I mean, it has a ways to go, and you could tell the panic. I mean, your question is a good question. How do you know when it's over, right? It's over when things like this happen. This is a big. This is one thing to say. This is like capitulation. You want to see, what capitulation means is they'll buy anything at any price, which it seems like it's happening now. That could be a picture of capitulation right there. That slope is that's like a 5 standard deviation move in slope right there. Yeah. But vol usually would come up a bit more, I think, before you would kind of call it a mini crash, and then it's not near COVID or the great financial crisis. There's another indicator. I'm going to take off contango for now. I'm going to look at there's a market width that I think's been interesting to watch. So market width is, let's stretch this out a little bit. Unfortunately, in market width, sometimes you get some bad readings. So so market width this is how wide the markets are in vol terms. Okay, so you could tell obviously COVID, they just widened it way out. Like when you're paying, usually SPY is about 0.1 IV point wide, like 15 to 15.1. That's how wide the markets are. You could tell it's gone up pretty significantly, like doubled, but you could also tell that it's still it's not really in anything near what we saw way back when. This is the good old days, Tyler, when we used to be market makers and you can make money with that wide markets. But let's just again, since May of 22, this has really been coming down, and I would also argue that has a lot to do not only the market rallying, but it was there was a fair amount going on at that time, but also that 0 DTEs has really helped the width of the market. So, but this is this is a capitulation thing by market makers. People are they just widen the markets out because people are buying from them, selling to them. They're losing a lot of money, so they just widen the markets out. Does that make sense on the market with Tyler?
Yeah, that is. It's interesting to see just how different it was a decade ago versus now.
Yeah.
And that's just a reflection of how much the options market has changed and its sort of, livelihood.
Yep, definitely. And it was, when I was trading, move it back 10 years from there, it was even wider.
Yeah.
So
how do you, I've heard a lot of people, losing money the last few days. How can you avoid that from happening? Like, what can you do in your trading to avoid this? Is there an indicator or a signal that you can look at, or is there a certain?
Yeah, I mean, it's a good question, and I feel badly for people. Listen, I've been on the floor when my backers were standing behind me, thinking I was going to go out of business when the stock was taken over, and we had horrible positions in the pit, and everyone lost all this money. So I know it's a terrible feeling. But if to those people that are losing money, lick your wounds, try to survive and trade another day. These are typically, I'm kind of the opposite of most people. Like, I make a lot of money during these times, but I pay for them, from here to here. I lost what I made in one day here. But that's the way I like to have my trades out there. So, I mean, if you don't want to lose money, because I have so many things that not just stocks, but the value of my house, the value of orats, all these things are positively correlated with the stock market. And so I want to have a lot of negatively correlated things. And the only negatively correlated thing that I think works consistently are puts. And puts are really expensive. So I've been, every week or every month, at least on the advisor's option on my podcast, what we talk about, I say never have short units, meaning you should always have a spreads on the downside. You could have long units, but never have short units. That's one way to do it. Another way to do it is to be be hedged. Like, so it was a difficult time to be, this cost me a lot of money from here to here with all the put calendars that I was long. I wouldn't have been able to afford it if it were just long puts or even long put spreads. Put calendars were the least expensive way to be long, lower curvature, meaning, those long calendars, way out of money long calendars, right? They blew up today. So that I made tons of money because they're way out of the money. The front month ones are, not worth that much. But the back months, they have a ton of Vega, and the Vega went crazy, got out of a lot of them. They still have a lot of them on. So
can we?
Go ahead.
Yeah, I really like what you said about the long put calendar, and I think it's important for our viewers to see that. Could you go to maybe the backtester and let's see how those perform during? We have a annual return during bullish markets, which is a really important metric to look at, and I think that would be neat to see.
Yeah. So let's see here. During bear markets, let's just put this in.
These are all of the long put calendar backtests we've already ran on SPY. So we've already ran all these backtests, and then they're in this table that we can filter them. And what Matt's doing right now is filtering, putting a minimum filter on the annual return during bear markets.
Yeah.
So we're going to get to see some really good long put calendars here.
When you start having to search through 10.3 million backtests, and it's not just that, because we have 180 million, so it does take a little bit of time. But the cool thing about this backtester is we could, kind of figure out what types of strategies do well in bear markets. And when we say bear markets, only the bearish markets timeframes are included. Financial crisis 2007 of Nov to Feb 2009, Volmageddon February 18, late 2018 bear market October to December, COVID crash 2020 to March 2020 and the 2022 bear market. So we're looking for calendars and various strategies that do well during those times, but maybe doesn't, lose you a lot of money in other times. So does that make sense, Tyler?
Yeah, it's an important metric to look at, and also I like what you said about the long put calendar. There we go.
So again, here are some stocks that do really well. Like here's one that had made 6%, and the annual return is still good, right? So again, you had is this the one 0.97? Yeah. So you had long term. This is exactly what I do. 20 delta, almost exactly what I do. You have a stop loss, which I don't do, but I have a profit target. I take it off when I make a lot of money on these things. And so, this is it. This is basically showing that, these are the types of long-term trades that can protect you and not cost too much.
Wow, that's interesting. Yeah.
I mean, see how you're just kind of losing a little bit. Like this market's rallying back in 2013, you're just losing. It's really hard to like keep that on, but then the market gets into duress, goes down, and you make a bunch, and then you make a huge amount on these things. This is what's going on.
Yeah. So even in a long-term overall bull market, you're not losing that much relative to what you're making in the crashes.
Yeah. I mean, I've been talking about the strategy forever, and I found out about it from our backtest.
Yeah.
So anyway, good question. And then just go back just quickly to what's going on in the market. So and your question was how do you know when it's over? When it's over, these things will start coming back in a real type of a way. And then sometimes you'll get blips and such, but you could see these things don't last long. But sometimes they do. This one lasted a fair amount of time, but it wasn't. The pain was over in 2011 pretty early. Same in 2018. That pain, before it turned around, right? So, and then there's the end of 2018. So it's these things are great to watch again for that as well, Tyler.
Yeah, do you have any idea what like some leading indicators would be? I mean, those you mentioned are lagging, trailing indicators.
Yeah, I mean, we talked about it earlier. I mean, all the ones are leading indicators. So what I'm going to be looking for, first of all, I think that slope was pretty interesting. That's kind of an aberration, but I want to see these turn down. They're already getting kind of stretched. So I think you could kind of like what the trade that I want to put on today is just a contrary trade that's not going to cost too much. It's going to be a long calendar. But or a long, you could do a long butterfly. Me, I tend to like the calendars, but these are so stretched and they move so much that we might get a pretty severe bounce back. And so I like to, I'd like to find a trade that's based on that, on a bounce back that doesn't cost that much. So, what I'd like to do, Tyler, is look at a long call calendar. I would say shorter term. So I'm going to do 2 weeks, but I'm going to widen it out just a little bit more.
Change. That's the spread, Matt. Change
the. Thank you. 2 weeks. Yeah. So we're going to be along this from 15 days to like that could be long. I don't want it to be too long term because there's a fair amount of risk in the Vega right now. So I don't want to be too, like maybe 40 days. And then this could be, 10 days and 7 to 18 is fine. So, because actually it could even be like 4 days. And then this is going to be way out of the money. So delta down, like 15, 5 to 20. So let's take a look at how these look. Yeah, so these are still a little bit pricey for what you can make. 5 to 1. Here's the 8 to 1 for 70 cents. So that's 551. So this is kind of what I'm talking about. This is a little bit long term. I'm gonna go from more like 3 days, yeah, to max of maybe 10 days. Like 5 would probably be what I'd prefer. So 10 days. Oh yeah. So maybe I think even 10 days is too many. All right, so let's look at that. So these are a little bit more expensive, but that's pretty far out of the money. What's the pop on these? Wow, they still say it's 47%. So these are a little bit risky. Let's do a little bit. We'll just do one out of the money with that doesn't cost that much. So $1.27. You're getting a little bit, not that much, and you're out of the money. But that, for how far out that is, you should be able to get that in. And then it's got a rally. Vol will come down. So so it'll probably come down a bit. So your max profit is probably, about $300 on this one. It's an okay trade, but that's a decent long one, I think. Let's look at a call spread too, Tyler. Again, 2 weeks. Are there any on the front page? Yeah, there's some on the front page. So call spreads, I want them a little bit more out of the money, I think. All right, so let's see, paying $2 for this thing. So it's got to go to 530. So it has to go to near 536. I think we could probably get out of that one too with a decent amount. I mean, 5 to 1. I don't know which one looks better to you on those two, Tyler.
I do kind of like the long call spread because if it doesn't move in our direction, the risk is still pretty low.
Yeah.
I mean, they both have pretty low.
High. Yeah.
They're about the same cost to put on. Yeah.
Right. All right. So that's a good point. And I've been talking about calendars, so let's just stay on it. Take a picture of it so don't forget. And let's force this trade. We'll give them a couple cents. 144 Theo. All right. So, yeah, Tyler, I think that was a good show. I think there's a lot to learn, especially from the old people and from the long-term graphs about these, what's happening in these markets. I think you could feel a lot more, at least confident in your decisions by using all this data that we have in your favor. So, like I said, vol could go a lot higher. This has a ways to come down. Slope, this is interesting that it's moved so much. The market width, yeah, I mean, this is, a lot of these have moved. Like that's a pretty big move for market width today. So, that could be, that's why I've gotten a little bit long, these ways. I put on a calendar today, just in case, because what happens in these times is the market will just roar back and then go down again and roar back. It's pretty crazy time right now. So, yeah, keep your powder dry, do a few trades here and there, and, don't bet it all on black.
All right. Thanks, Matt.
Yeah.
Yeah, I really like that long put calendar in this market. I think that's, your strategy there is pretty neat.
Yeah, you can't really put it on now because the vol's so
Right.
high. But if the vol starts coming down a little bit, you could get into some vol calendars that'll, because there could be another shoe to drop.
Right. Okay. Yeah, well, thanks for going over that. And it's been a crazy few days in the market. So appreciate you talking about the current market and giving us some insights into that. If you have any questions about our tools, you can always reach out to us at support@orats.com. You can also, if you're a subscriber, you can go to our community tab and ask questions there. If you're just a viewer, you can leave comments on the YouTube channel and we'll always get back to those. And then we'll see you guys next week, and we'll see how the markets are faring then. Thank you, Matt. See you guys next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.